Imagine it is the 14th of October, 1987. You're a 43-year-old accountant living in a modest three-bedroom house in the suburb of Evanston, Illinois, just north of Chicago. Your name is Robert. You drive a Buick. You coach your son's Little League team on Saturdays. You have been disciplined your whole life with money. Never flashy, never reckless. Over the past 6 years, you have carefully put aside $42,000 into a diversified portfolio of blue-chip stocks. Not speculative ones, not penny stocks. You chose the biggest names on the American market. Solid companies, household names, the kind your father told you would always be there. You sleep well at night. You tell your wife, Carol, that you have planned for everything. If you have ever wondered why something can feel completely safe and still destroy you financially, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, and it always ends the same way. The feeling of safety and the fact of safety are two entirely different things. And history is littered with the wreckage of people who never learned the difference. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. On the morning of October 19th, 1987, Robert wakes up, makes coffee, and turns on the television. By the end of that single trading day, a day that will be recorded in history forever as Black Monday, his $42,000 has become $29,000. Not because the companies were fraudulent, not because he made bad choices by the standards everyone around him used, but because the thing he trusted was never actually as safe as it felt. In one day, the Dow Jones Industrial Average fell 22.6%, the single largest percentage drop in history. And Robert was not alone. Across America, people who had done everything right by the conventional wisdom discovered that safety was a costume. Underneath it was something very different. This video is about that gap, the gap between assets that feel safe and assets that actually are safe. It is one of the oldest and most repeated patterns in all of economic history. It has destroyed middle classes in countries from Germany to Argentina to Lebanon to Japan. It has taken the savings of careful, disciplined, hardworking people and turned them into ruins. Not because those people were foolish, but because they trusted feelings instead of structures. By the end of this video, you will understand the mechanism that creates this illusion of safety. You will see it in action across 5 different eras in 5 different countries. And you will understand why, despite being one of the most important financial lessons in history, it is almost never taught in schools. Before we go further, there is something important to understand. The illusion of safety is not an accident. It is not simply a matter of bad luck or unavoidable chaos. There's a specific mechanism, a specific set of conditions, that reliably produces the gap between how safe something feels and how safe it actually is. Think of it this way. Imagine a bridge over a river. Every day, thousands of cars drive across it. It holds. It holds again. It holds for years. And because it holds, people begin to believe it will always hold. Engineers begin to skip certain inspections. Maintenance budgets get cut. The feeling of safety generated by the bridge's track record becomes the very reason the bridge is no longer being maintained. And then one morning, without any visible warning to the drivers crossing it, the bridge gives way. This is the core mechanism behind almost every case in which an asset felt safe, but was not. Safety, when it is real, comes from structure, from the underlying strength of what you own. Safety, when it is false, comes from track record, from the fact that something has not collapsed yet. Most people and most institutions confuse these two things. They mistake the absence of collapse for the presence of strength. The distinction sounds simple, but the consequences of ignoring it have been catastrophic repeatedly across centuries. There are 3 specific conditions that history shows us create this illusion most powerfully. First, when an asset has a long track record of stability, long enough that living memory no longer includes a collapse. Second, when the asset is widely held by ordinary people, meaning social proof reinforces the feeling. And third, when official narratives, government statements, bank communications, financial press actively confirm the safety story. When all 3 of these conditions are present at the same time, the illusion becomes almost impossible to resist. And when the illusion eventually breaks, the damage is not limited to bad investors. It reaches deep into the savings and lives of the most careful, ordinary people. This brings us directly to the first major case study in this story, and it begins not in a trading room or a bank boardroom, but in the kitchen of an ordinary Japanese salaryman in Tokyo in the late 1980s. Japan in 1989 was one of the most economically impressive nations on earth. It was not just wealthy, it felt invincible. Japanese manufacturing had conquered global markets. Japanese companies were buying American landmarks, the Rockefeller Center, Columbia Pictures. At the peak of the bubble in 1989, the land under the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California. Japanese real estate and Japanese stocks had both risen dramatically and consistently for decades. To own property in Tokyo was not considered speculation. It was considered the most responsible, most rational thing a Japanese citizen could do with their savings. The track record was extraordinary, the social proof was overwhelming, and the official narrative from Japanese banks, from the government, and from the financial press was uniformly, almost universally positive. The mechanism operating beneath this feeling of safety was something economists call an asset price bubble, which means prices have risen above underlying value. Think of it like inflating a balloon. You can keep blowing air in, and for a long time, the balloon gets bigger and nothing bad happens. But the balloon is not stronger because it is bigger. It is more fragile. In December 1989, the Nikkei stock index peaked at nearly 38,916 points. By August 1992, it had fallen to around 14,000. That is a decline of roughly 63%. Japanese real estate followed the same path downward. But more slowly and more painfully, values in some commercial areas fell by 80 to 90% over the following decade. What made this particularly devastating was not just the numbers. It was who owned these assets. Ordinary Japanese workers had been encouraged to put savings into real estate. Pension funds held enormous quantities of domestic stocks. Banks had used real estate as collateral for loans, lending on the assumption property values would hold. When they did not hold, the loans collapsed too. Japan entered what economists now call the lost decade, though many argue it was closer to 2 lost decades. A period of near zero economic growth, widespread business closures, and persistent unemployment that stretched from the early 1990s well into the 2000s. People who had done everything right by the standards of their culture found that the safety they had trusted was a mirror, a perfect reflection of the past, with nothing behind it. This leads to the second part of this story. And this one moves us from Asia to South America to a moment so compressed and violent that the illusion did not dissolve slowly. It shattered in a single weekend. Here is something I want you to think about before we go further. If you had lived your whole life in a country with a currency tied to the United States dollar, told repeatedly by your government that this peg was permanent, guaranteed, the foundation of your economic security, and then one weekend that guarantee simply vanished, what would you have done differently, if anything? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. Argentina in the 1990s had a financial system built around what was called the convertibility plan, implemented in 1991 by Economy Minister Domingo Cavallo. This plan pegged the Argentine peso 1-to-1 to the United States dollar. 1 peso equaled $1. The government promised this was permanent. For most Argentines, keeping their savings in pesos, or even in Argentine bank accounts, felt exactly as safe as holding US dollars. The track record was strong. Inflation, which had been catastrophic in the 1980s, was tamed. The economy grew. International investors poured money in. Foreign banks opened branches. The feeling of safety was not irrational given the information ordinary Argentines had access to. It was the natural result of a decade of apparent stability reinforced by official assurances. But the structure underneath was not stable. Argentina's government had been running persistent deficits, spending more than it collected in taxes. It was financing these deficits with debt, much of it denominated in US dollars. As long as confidence held, this was manageable. But confidence in financial systems works exactly like a queue. The moment the first few at the front start to leave, everyone behind them panics and the queue dissolves instantly. By late 2001, Argentina's government debt had grown to unsustainable levels. International lenders pulled back. The government attempted to stop capital fleeing. They imposed what became known as the corralito, a restriction that froze bank accounts and limited withdrawals to just 250 pesos per week. Think about what that meant for ordinary people. A pharmacist in Buenos Aires who had saved responsibly her entire life could now access almost none of it. The corralito was announced without warning on December 3, 2001. By January 2002, the convertibility plan was abandoned. The peso devalued dramatically, eventually settling at roughly 3 pesos to $1, meaning the purchasing power of peso savings had collapsed by approximately 2/3 almost overnight. People who held their savings in Argentine bank accounts in pesos saw 2/3 of their real wealth erased, not because they were reckless, but because the asset that felt completely safe turned out to have no structural foundation when the pressure became sufficient. Now here is where it gets interesting, because the people who came through the Argentine crisis with their savings intact were not smarter in the technical sense. They were those who had, for various reasons, sometimes distrust, sometimes family history, kept their savings in physical US dollars, outside the banking system, not invested cleverly, not diversified into complex instruments, just cash, in a different form, outside the system that collapsed. The simplicity of what protected people in Argentina in 2001 is one of the most important details in this entire story. This leads us to the third part of this story, And this one requires us to go back much further to a case that is almost a century old. Germany in the early 1920s offers what is perhaps the most dramatic example in all of economic history of an asset that felt safe, proving to be unsafe. We are talking about the German mark, the currency of a major industrial nation, a currency with a long history used by ordinary workers and pensioners. Weimar Germany between 1921 and 1923 experienced hyperinflation, which means prices rising so fast that money becomes worthless faster than you can spend it. In January 1921, a loaf of bread cost 0.13 marks. By November 1923, that same loaf of bread cost 200 billion marks. Workers were paid twice a day because prices rose so fast that wages earned in the morning were worth significantly less by afternoon. People used banknotes as wallpaper literally because the paper was worth more as insulation than as currency. Wheelbarrows were used for buying basic goods. But the people destroyed were the German middle class, savers, people who had worked for decades and deposited their savings in banks, people who held government bonds, which means they had lent money to the German government and received a paper promise of repayment, people who trusted the mark, because the mark had always been the mark. Their savings were not just reduced, they were erased, completely, down to zero in real terms. And the social consequences of this, the humiliation, the fury, the destruction of the class that typically provides social stability, contributed directly to the political radicalization of Germany in the decade that followed. The illusion of safety in a currency, when it collapsed, did not just take money. It took futures, trust, and ultimately, stability itself. Most people will never know what you now know. Most people will keep trusting systems they do not understand, in the same way that Germans in 1921 trusted marks, or Argentines in 1999 trusted pesos, or Japanese investors in 1988 trusted real estate that had never fallen. If you are still here, you're not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all of these cases have in common. Japan, 1989, Argentina, 2001, Germany, 1923. 3 different countries, 3 different centuries, 3 different types of assets. Stocks and real estate, bank deposits in a pegged currency, and a national currency itself. And yet the mechanism is identical in each case. Step 1. A long period of stability generates a widespread feeling of safety. Step 2. Official narratives confirm and amplify this feeling of safety. Step 3. Ordinary people, acting rationally, given the information available to them, concentrate their savings in the asset that feels safest. Step 4. The underlying structure develops weaknesses that are either not visible to ordinary people or are actively obscured by those with an interest in maintaining confidence. Step 5. A triggering event, sometimes a single piece of news, sometimes a government decision, sometimes an external shock, causes confidence to break. Step 6. The collapse is far faster and far deeper than almost anyone predicted, because the feeling of safety had drawn in enormous concentrations of ordinary people's savings. Step 7. Those without the right asset in the right form lose enormously. Those who held their savings in a different structure, one with real underlying value independent of confidence, largely survive. This pattern does not belong to any particular era or any particular political system. It appears in capitalist economies and communist ones, in democracies and authoritarian states, in rich countries and poor ones. The mechanism is not ideological, it is structural. It is what happens when the gap between perceived safety and actual safety becomes too wide for too long. And when it closes, it does not close gradually, it closes all at once. And this is where history gets uncomfortable, because we have not yet talked about the full human cost of this pattern. We have talked about numbers. Now we need to talk about people. Who gets hurt most when safe-feeling assets fail? History is very consistent on this point. The answer is almost always the same. It is not the very wealthy. And it is almost never the very poor. Not because poverty is protective, but because the very poor typically have so little to save that they have not concentrated significant wealth in any particular asset. The group hit hardest, in case after case, is the careful middle class. The accountant, the teacher, the pharmacist, the retired civil servant, the small business owner. These are the people who have worked long enough to accumulate savings, who have been responsible enough to put those savings somewhere, and who have trusted the assets that their culture, their government, and their peer group told them were the right places to put money. Look at Cyprus in 2013. This is a more recent and very specific case. Cyprus was a small island nation with a banking sector that had grown enormously. Its banks held assets worth roughly 8 times the entire annual output of the Cypriot economy. These banks had invested heavily in Greek government bonds. When Greece restructured its debt, which means Greece told its creditors they would only be repaid a portion of what they were owed, Cypriot banks suffered enormous losses. The Cypriot government turned to the European Union for a bailout. The terms of that bailout included something that had never been done in a modern European economy before. Depositors, ordinary people with savings accounts in Cypriot banks, were required to contribute to the bailout. Anyone with more than 100,000 euros in an account at the largest bank, Laiki Bank, lost a significant portion of their savings. Estimates suggest that depositors above the threshold at Bank of Cyprus lost approximately 47.5% of the amount above 100,000 euros. People who had built small businesses, people who had been saving for retirement, people who had put money in a bank, the action universally described in every financial education resource as the safe, responsible thing to do, found that safe had meant something different from what they had been told. And in Lebanon, beginning in 2019, a similar story unfolded. Lebanese banks had been offering remarkably high interest rates on deposits for years, rates that attracted savings from both Lebanese citizens and the diaspora living abroad. These rates felt like a reward for being responsible. By late 2019, the Lebanese financial system began to seize. Banks imposed informal capital controls, restricting how much money people could withdraw. By 2020, the Lebanese pound had lost more than 80% of its value. Depositors who had kept their savings in Lebanese banks found themselves unable to access their money, and when they could access it, its real purchasing power had collapsed. In some cases, people with life savings equivalent to hundreds of thousands of dollars found themselves withdrawing cash worth a fraction of what they had deposited, at exchange rates far below what the banking system officially acknowledged. Doctors, lawyers, engineers, teachers, the educated, careful, responsible professional class were among those most thoroughly devastated because they were exactly the people who had saved the most and who had trusted the most. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. Now we come to what history actually shows about those who navigated these events with their financial lives intact. This section is not financial advice. What follows is a description of patterns that historians and economists have observed in studying survivors of these events, what they had in common, what the historical record shows. It is not a recommendation for any individual course of action. The historical record shows that those who came through these periods of asset illusion largely shared several characteristics. The first is that they held assets whose value did not depend on confidence. Physical gold is the oldest example of this principle. In Weimar Germany, those who held gold, even small amounts, found that it retained purchasing power while paper savings dissolved. In Argentina, in 2001, those with physical dollars outside the banking system retained their wealth. In Lebanon, those with property abroad or with savings in foreign banks and stable currencies were insulated. The common thread is not any specific asset. It is the structural principle. They held something whose value came from itself, not from a promise. The second characteristic is that they had maintained some diversification, which simply means they had not put everything in one place. Not because they predicted the crisis, but because their general philosophy, often formed by family history or personal experience with earlier instability, led them to distrust any single system completely. A Turkish grandmother who lived through multiple currency crises in the 20th century and kept some gold sewn into the lining of her coat was not making a sophisticated financial prediction. She was carrying the memory of what had already happened once. That memory was a form of protection. The third characteristic, and this is perhaps the most surprising, is that many of them held a portion of their wealth in assets that were less liquid but more structurally real. Productive land, a small business with real customers and real revenues, a skill set that had value regardless of what currency or system surrounded it. The doctor who can practice medicine survives financial collapses better than the accountant whose savings are tied up in the system that collapses. Not because medicine is a better profession in normal times, but because the skill itself retains value when paper promises do not. History does not tell us what to do with money. But it does show us, repeatedly and across wildly different contexts, that the people who survived the collapse of safe-feeling assets were those who had, at some level, distinguished between the feeling of safety and the structure of safety. They were not all geniuses. They were not all rich. Many of them were modest, ordinary people who had simply maintained a quiet skepticism about any promise of permanent security. They understood, perhaps instinctively, that safety is never a fixed state. It is always a condition that must be continuously justified by structure, not merely supported by track record. Let us come back to Robert, the accountant from Evanston, Illinois, the man we met at the start of this story, the one who woke up on October 19, 1987, and watched 31% of his savings evaporate in a single trading session. Here is what actually happened to people like Robert. The market did eventually recover, The Dow Jones, which had crashed so dramatically on Black Monday, slowly climbed back. By 1989, it had regained most of its losses. So, in this particular case, those who held on and did not sell in panic eventually recovered. But that recovery was never guaranteed. Robert did not know in October 1987 that the market would recover by 1989. He could not have known. He was living through an event with no clear endpoint. And many of the people who watched their savings fall, particularly those who were closer to retirement and could not afford to wait years for a recovery, made decisions in those weeks that locked in their losses permanently. The lesson of Robert's story is not that stocks are unsafe. It is something more nuanced and more important. It is that assets which have a long track record of stability are not automatically structurally safe. Track record tells you about the past. Structure tells you about conditions, about whether the thing you own has underlying value that exists independently of the story being told about it. Robert's mistake was not choosing stocks. It was believing that stocks, or any single type of asset, had achieved a permanent state of safety that no longer required scrutiny. The pattern across all of these cases, Japan, Argentina, Germany, Cyprus, Lebanon, and the streets of Evanston in 1987, is the same. Safety is not a property that assets have permanently. It is a condition that assets maintain until they do not. And the gap between when an asset feels safe and when it actually stops being safe is where ordinary, hardworking, responsible people's life savings go to disappear. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Every country and every era presents its own specific conditions. And the patterns described in this video, while repeated across history, do not allow us to predict specific future events with certainty. Please consult a qualified financial professional before making any decisions about your money or your savings. The purpose of this video is to help you think more clearly about economic history, not to tell you what to do. This video is not for everyone. Most people will dismiss it. They will say their bank is different, their country is different, their government would never let that happen. And most of the time, most places, they will be right. But if one person in your life has their savings concentrated in something that feels safe without understanding why it actually is safe, if one person you know has never thought about the difference between a track record and a structure, share this with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.